Your parents probably told you the same thing mine did. Work hard. Pay your taxes. That's just how America works. And every April, you do exactly that. You open your W-2, you plug the numbers into TurboTax, you watch a chunk of your paycheck disappear into the IRS, and you tell yourself, well, everybody pays. That's the deal. But here's the thing, nobody told you. While the average American family paid around 13% of their income in federal taxes, one of the most valuable companies in the world, a company that made over $11 billion in profit in a single year, paid zero. Not 0%. $0. And then the IRS actually sent them a refund check for $129 million. Welcome to the world of Amazon's tax strategy. A world where the more money you make, the less you seem to owe. A world where the rules you follow were never really written for you. So in this video, we're going to break down the tax loopholes that saved Amazon over $15 billion, why they're completely legal, and whether any of it is ever going to change. Let's get started. Section 1. The historical context. When the game changed. To understand how we got here, you have to rewind to the 1950s. Back then, the top corporate tax rate in America was 52%. Companies paid roughly a third of all federal tax revenue. If you were General Motors or US Steel, you accepted it as the cost of doing business in the richest country on earth. Then came the slow unwind. Reagan cut the rate in the 80s. Clinton kept it steady. Bush trimmed it again. By 2017, the statutory corporate rate sat at 35%, which on paper was high, but in practice, almost nobody actually paid it. Then, in December 2017, Donald Trump signed the Tax Cuts and Jobs Act. The statutory corporate rate dropped from 35% all the way down to 21%. Supporters said companies would use the savings to raise wages and invest in America. Critics said it was a giveaway. But here's what actually happened. The law didn't just lower the rate, it also layered on brand new deductions, immediate expensing for equipment, expanded credits, carve-outs on carve-outs. The rate went down and the loopholes got wider. It was Christmas morning in Seattle. The numbers tell the story. Between 2018 and 2021, Amazon reported over $78 billion in US income. At the full 21% rate, they should have paid more than $16 billion to the IRS. Instead, they paid about $4 billion. That's an effective rate of 5.1%, less than a school teacher, less than a nurse, less than you. That gap, the difference between what Amazon owed on paper and what Amazon actually paid, that's the $15 billion we're talking about. 3. Section 2. The core mechanism. How the loopholes actually work. Okay, so how do you legally skip a $15 billion tax bill? Let me use an analogy. Imagine taxes are like a game of Monopoly. Every time you pass go, you're supposed to hand over 10% of what's in your hand. Simple, fair. But now imagine there's a second rule book, one that only the biggest players get to read. And that rulebook says, if you can prove you spent money on certain things, you don't have to count them as money at all. That's essentially what Amazon does. And there are 3 big plays in their rulebook. Play number 1. Stock-based compensation. Amazon pays a huge portion of its employees, especially engineers and executives, not in cash, but in company stock. When those stock grants vest, Amazon gets to deduct the full market value from its taxable income. Here's the wild part. Amazon never actually spends the cash. They just print more shares. But the IRS still lets them write it off as an expense. In one recent 4-year stretch, stock-based compensation deductions alone saved Amazon over $1 billion in taxes. Play number 2. The R&D tax credit. The government rewards companies that spend money on research and development because, in theory, innovation helps America compete. Amazon spends tens of billions on R&D every year. Alexa, drone delivery, AWS infrastructure, the Kindle. all of it qualifies, and each dollar spent generates a credit that reduces Amazon's tax bill. In 1 year, R&D credits alone shaved off $419 million. Play number 3. Immediate expensing of equipment. The 2017 tax law lets companies deduct 100% of the cost of new equipment, like warehouses, servers, and delivery vans, in the year they buy it, instead of spreading it out over 10 years. Amazon, which is building fulfillment centers the size of small cities, gets to write off billions in one shot. Stack those 3 plays on top of each other, year after year, and here's the counterintuitive truth. The more Amazon grows, the more it invests, and the more its stock price goes up, the less it owes in taxes. The system is literally designed to reward the biggest players for getting bigger. Section 3. The hidden power. Who's actually benefiting? Now here's where it gets uncomfortable, because when Amazon doesn't pay, somebody else has to. And that somebody is you. The shadow player in this story isn't one single villain. It's a quiet partnership between 3 groups. Corporate tax lawyers who lobbied for these deductions to exist, Congress who wrote them into law, often with the direct input of those same lobbyists, and Wall Street, which rewards CEOs for driving down the effective tax rate because every dollar saved on taxes is a dollar added to the share price. And here's the direct impact on your wallet. Federal revenue that doesn't come from corporations has to come from somewhere. It comes from payroll taxes taken straight out of your paycheck. It comes from income taxes on your W-2. It comes from the Medicare and Social Security contributions you can't deduct your way out of. In 1952, corporations paid about 32% of all federal tax revenue. Today, that number is closer to 9%. The rest of the tab, you're picking it up. And then there's the domino effect. When Amazon pays an effective rate of 5%, every other public company has to match it. Because if you're the CEO of Walmart or Target and your tax bill is 3 times Amazon's, your shareholders are going to ask why. So the entire corporate world races to the bottom. Lobbyists push for more loopholes, tax departments get bigger than accounting departments, and the people writing the tax code are often the same people who used to write Amazon's tax returns. One company's strategy becomes the entire industry's blueprint, and eventually the blueprint becomes the law. Section 4. The reality check and conclusion. Here's the harsh truth. Amazon didn't break a single law. Not one. Every deduction they took was written into the U.S. tax code by Congress, signed by a president, and approved by the IRS. The $15 billion Amazon saved isn't the result of cheating. It's the result of the system working exactly the way it was designed to work, for the people it was designed to work for. And that's the real story. It's not that the rules were broken. It's that the rules were built this way on purpose, big enough to drive a fleet of prime vans through. And the only way that changes is if Congress closes the loopholes, raises the minimum corporate tax, or ties the rate to the size of the company. In 2022, a 15% corporate minimum tax was passed for companies making over $1 billion. It helped. Amazon's bill went up, but the loopholes are still mostly intact, and the stock-based compensation deduction still alive and well. So what can you do? Honestly, not much at the individual level. You can't deduct the rent you pay the way Amazon deducts the warehouses they build, but you can understand the game. You can vote for representatives who actually care about tax reform. And you can stop feeling guilty every April when you hand over your fair share, because most of the companies you're buying from aren't handing over theirs. So let me ask you this. If you ran a business that made $35 billion in profit, and the law said you could legally pay 5% in taxes instead of 21%, would you do it? Drop your answer in the comments. I read every one. If this breakdown helped things click for you, hit that like button, subscribe for more videos like this one, and I'll see you in the next one.